I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Sean Brodrick, natural resource specialist at the Oxford Club. His website, energyandresourcesdigest.com. Welcome back to the show.
Thanks very much for having me on.
Well, a rare snowfall in Vancouver, and natural gas prices are going up.
Yes, we're in the prime part of the season for natural gas. From about mid-December to mid-January, natural gas can do extremely well simply because things get cold. And for some reason, the traders in New York, when they walk outside for a cigarette break and it's actually cold, they have to put on their jackets, they bid up natural gas. And so that's kind of what we're seeing now, and it's been great for many of my positions, I have to tell you. This is an excellent time to be long natural gas producers.
We thought, of course, natural gas would pick up. It took a bit longer than expected.
Yeah, but that's okay. Just gave us a chance to buy some stuff cheaper. That's cool. Now, of course, people were thinking, oh, I don't own enough. But you know what? I'm actually expecting, because we've had a nice bull run since the election in the U.S., right? And I think that we're in some kind of, don't want to call it a buying frenzy, but I just think that we might hit a short-term buying climax. Let's use that word, just as long as there are no censors on this radio station. And so I think that we'll see things kind of ease off for a bit. So if you didn't get a chance to buy, I don't think you should buy right now. I think you should wait for that pullback because it's coming. Nothing goes in a straight line. And so that's fine. We'll see things ease off a bit. The hot money will rush out. That'll push things down. But I think for a bunch of reasons, and in fact, I've written about them in EnergyandResourcesDigest.com. I'll add that. I think for a bunch of reasons, we're actually going to look at a bullish first half of 2017 for a whole bunch of things. The stock market especially, because they're lowering corporate taxes, and one analysis of that says that should raise, on its own, earnings for the S&P 500 by about 9%. So that's one thing that's really bullish. We're going to see a rollback of, regulations. Now, if you regulations, that's not a good thing, but from a investor's point of view, less regulations means less red tape, which means companies can do things cheaper, which makes our companies more competitive around the world. And so that also puts a lift under the market. Then they might have a tax holiday for all the corporate cash. I think there's $2.5 trillion worth of it that's stashed overseas, and let them bring it back for a 10% tax rate. Now, of course, they wouldn't bring it all back. But the last time they did that, which was in the George W. Bush administration, $300 million came back. And the funny thing is they say they're having this tax holiday, so they'll bring that money back and invest in new factories and stuff like that. That's not what they put the money into, if history is any guide. What they put the money into is corporate buybacks. Companies buy back their own shares, and they also raise dividends. So from an investor, it's a win-win point of view. So people should be looking at those stocks that have a lot of cash overseas, because if this tax holiday goes through, and I don't think there's much to stop it, then those companies will be bringing a lot back, and they'll be doing a lot with it.
In Italy, the people did not pass the referendum to give the government more power, and Renzi has resigned. It seems like the markets, at least this side of the water, haven't really reacted to that.
And that's a curious thing, considering how much debt Italy has. It's funny for the market to shrug that off. I think this is worse than Brexit, potentially. Because what if Italy can't pay its debts? That's actually kind of a big thing, but the market doesn't seem to care. And if the market doesn't care in the short term, we aren't going to care either, But maybe that's the thing that will finally make this bull rally pause when people say, hey, wait a minute. Look at Italy. That's maybe not the simple situation we thought it is. It's much more complicated. There's a lot of debt. Things can really go wrong. Maybe that's what will cause the pause. We don't know what will cause the pause, only that with each day of the rally, a pause becomes more and more likely. It's just, that's just the law of averages. So I don't know what will cause the pause. It could be Italy. And if that happens, you know what? They won't allow Italy to fail. So I think that people should just take that opportunity. I don't think this vote is actually the best thing for the people in Italy. I think it's actually going to make their lives harder, but I can understand why they voted the way they did. No one wants to vote, harder things on themselves. So that's one of the problems of democracy. So I think that something will cause a short-term pullback in the market. It might be Italy. When that happens, then you should have your shopping list ready. It might last a week or two. So what? That's when you can actually pick things up cheaper.
Oil, after the OPEC agreement, continues to climb. Will it hit $52 a barrel?
Here's where I have to do a mea culpa, because at first I thought it was not going to work. Because every time OPEC has tried to do this kind of thing, they just trip over the wallpaper walking down the hallway. It's just, they can't organize. But what they've done differently, and this is very important, is they aren't going to let they aren't going to let countries report their own production. They are going to verify it by independent sources, which makes cheating harder. And this is why the market likes this and thinks this deal can actually succeed. Can the deal actually succeed? I give it about a 50-50, but that's better odds than they've had in previous attempts. I will point out that OPEC production hit a new high in November. Russian production has hit a new high. The market is glutted with oil, and as prices go higher, U.S. producers and Canadian producers will crank open the taps as well. That's not a simple thing. It takes time to actually get the production out there. But when you look at it, I think that in the short term, this could stick. Longer term, I think it's very problematic because of all the production that will come online from North America. We'll just have to see how it works out. But the odds are that OPEC's more likely to stick with these agreements because it's not as easy for them to cheat as it has been in the past. That doesn't mean they can't. And if they can find a way around it, you can bet your bottom dollar they will cheat. So, the thing's up in the air, 50-50, but that's good enough for the market, and that's why we're seeing the price of oil a bit higher.
Now, last spring, everybody kept saying all the storage facilities, all the tankers are full. My goodness, what can we do with all this oil? That never happened.
Well, they did kind of fill up for a while, but the thing is you can always build more storage. China is building storage by the acre. They just have a tremendous amount of it. And so, they're just storing more oil there. And so we'll see how that goes. But there's no limit to storage potentially. It's just how fast you can build it. For a while, it was close. They were actually topping out on storage in important markets in Europe and stuff. But that seems to have passed for now. Doesn't mean it can't come back, though.
We'll have more with Sean Brodrick right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Sean Brodrick. Sean, gold continues to go down. It's around 1174 right now. Did you expect it to go this low?
No, I did not. I will tell you some good news though. If you are bullish on gold, is we saw select miners, the ones I follow, the good ones, actually bottomed last week. And even though as you and I talk right now, gold is down $5.75, something like that in U.S. dollar terms, a lot of good miners are up. So obviously the market is pricing in some kind of bottom. Now it simply might be that the shorts just jumped all on board and leaned too far to one side, and that could be what's going on. And now they have to take some of that off because they're seeing less return, so the hot money's flowing out, and that's what's putting a bid into the miners right now. I don't know. But the action in the market tells us that a bottom should be close. It doesn't mean it has to be the bottom. And I have to tell you the big problem for gold now, because I just told you the optimistic thing, the pessimistic thing, is that 10-year yields in the U.S. are actually going higher and higher and higher. And why does that matter to gold? Is because that's the carrying cost of gold. I've written about this a lot. When interest rates were really, really low, then there was no cost to owning gold, you know? I mean, well, you had to store it, obviously. But I mean, you wouldn't be making really much money in a 10-year treasury note. So, certainly then, buying gold was less of a gamble. And now, with the yields going higher on bonds, then you can put money in bonds and actually get something out of it, and that makes gold less attractive as a harbor of safety, because bonds are, you know, pretty safe. So, this is the dynamic going on in the gold market right now. As yields go higher, the price of gold tends to go lower. That said, we may be seeing a top in the U.S. dollar. This may be indicative of much larger action, maybe in the bond market, maybe in gold, stuff like that. And so, it should be a really volatile market for the next week or two. I would definitely keep my eyes peeled. You don't have to buy anything. Just have your shopping list ready, because if we are getting that short-term bottom, well, you know the stocks that will take off. Probably I'm just speaking to your listeners, but they know the ones that react strongly when there is a bottom in gold. And those are the names that you should be looking at, because if we are getting to that bottom, then you want to be able to pick up, you know, you don't have to put everything to work, but just pick up some of those names and ride it higher. Now, gold is in a downtrend now, and so that's kind of problematic. Gold has to break out of that downtrend, it has to go up, retest the most recent high again. It has a lot of work to do, but I would rather be long than short at this point. Actually, the thing you want to be is neutral right now, but I would rather be long, because the odds of a bottom are actually increasing. And so from that point of view, you know, that's where you want to be, because the bearish story has been working for a while in gold, but all the speculators already piled in. There's no one left to sell. And so I think that from that aspect, you know, this is actually a pretty good week for gold, and so we'll see how it ends. But actually things look pretty good.
And of course, silver's been behaving a little weirdly, or has it?
Yeah, it has. For one thing, it's more bullish than like gold right now. But I think that's because of global anticipation of a higher economic growth. We are seeing good news out of China. The fact is, they'll probably spend $2 trillion on infrastructure this year. That's what they spent last year. They tend to raise it every year. In the U.S., President-elect Trump says that he wants to spend $1 trillion a year on infrastructure for 10 years. And so, that's indicating to people that there's going to be a infrastructure build out, not only here in the U.S., but continuing in China, continuing in other parts of the world. Africa has a lot of infrastructure going on right now. So, put those things together, and so, since silver is an industrial metal, you know, I think it gets a tailwind from that. Metals people might want to look at, and they've already had great runs. So again, you wait for your pullback. That said, I put people in positions not too long ago, a week or two, but they're looking great. So I'm really happy with this, is the industrial metals. They are really performing well, because we keep seeing these talking heads from like Wall Street come out and say, okay, that's it. Copper's gone as far as it can. And they say, okay, that's it. Nickel's had enough. And okay, that's it. Iron can't possibly go higher. And what happens? The next week they go higher again. Now, some of this may be speculation. That's absolutely right. But you can't argue with the fact that at the end of last year and the beginning of this year, there were a bunch of mines shut down. Zinc especially. We saw some zinc mines shut down, but other stuff as well. And other mines were delayed and pushed off, which means that there isn't supply for the rising demand. Now, You can argue a case whether or not this is speculative demand that's really driving this. And maybe it is, I don't know. But I have to say that things look bullish for the industrial metals, and people are generally getting the feeling that there's going to be more industrial activity. And just coming back to silver, that's one of the things pushing silver higher, because it is an industrial metal along with being a precious metal.
And plus there's solar developments like crazy all over the world, and they usually use silver.
They do. They use less silver per panel every year, by the way. The thing is that the solar industry has been growing so fast that they use more silver anyway. But they're getting more efficient with the amount of silver they use per panel. So keep that in mind. I don't know where that ends either. I think President-elect Trump would be crazy to stand in the way of that. And we have some like tax credits that have a couple more years to run. That could work out very well for silver here in the U.S. In China and Europe and around the world, they are just going full steam ahead, installing solar, wind, you name it. They want to move away from coal, and that's the global trend.
Sean, I know you have to run, so thank you so much for chatting with us.
Thanks very much. It's always great talking to you and your listeners, and it should be an exciting week. Stay tuned.
My guest has been Sean Brodrick, Natural Resource Specialist at the Oxford Club. His website, energyandresourcesdigest.com. You're listening to HowStreet.com Radio. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.